So exciting. Welcome to First Move's Crypto Crazy Week, where we begin with some good old-fashioned myth-busting. Cryptocurrencies are so called because they are digitally encrypted assets, but as a currency that's hard to decipher, the name is fitting for that reason too. To unravel some of the most common misconceptions, I talked to Luke Martin, the founder of Coinist Research, an independent cryptocurrency analysis company. He began by addressing what he sees as one of the biggest.
I think the biggest thing that still gets brought up and maybe is misunderstood or not known is how well Bitcoin has done. Even this year, a lot of people still think that everyone's underwater on the Bitcoin they bought. There's only been maybe 3 months, I think at the end of 2017 up until January of 2018, that Bitcoin traded higher than where it is today. And we hit 13K earlier this year and have 3X nearly in value. So there's still this stigma that everyone is underwater when in fact it's been the best performing asset for 5 years, 3 years, and this year.
I mean, that's fascinating, isn't it? I guess some part of that is the sheer volatility, and it depends where, as an investor, you got in here, because you could have bought high and sold low, unfortunately. But your point is, if you look over a longer period of time, you're still up.
Certainly. I mean, there was a very small window where, yes, if you did buy the top somewhere between November and early January of 2018, then yes, you're definitely underwater. But I think that gets overblown, and it also kind of keeps investors from getting into an asset that's been uncorrelated to other assets and has also performed this well.
We'll come back to that, lack of correlation. Volumes. One of the key questions we got asked was, look, explain the volumes here. Are the volumes fake?
Yep. Volumes, it's a bit of a gray area because reports come out. Bitwise did an excellent report where they covered and said all of the volume is fake, or most of the reported volume is fake. And that might be true based on reported volume, but there is a lot of real volume as well. I talked to a trading team, Alameda Research, out of Asia, which does billions in volume every single day, and they do more volume than even Bitwise said was happening on some of these exchanges. So there's a large amount of real volume and also a large amount of reported fake volume. There is a lot of things happening here. Reporting is maybe the tough part.
The Gemini twins, I remember going back to, what was it, 2013, and they said that they're at least 1% of the Bitcoin market, and everyone went, whoa, the Bitcoin whales. What percentage still dominated by big players, perhaps, versus the broader retail participation that we see right now?
Sure, whales still make up a good portion of the market. They will, right?
How good?
It's hard to say. It's hard to quantify, right? That's what makes the reporting part so tough. But it's still also a very retail-driven market as well, right? A lot of Wall Street and other institutions just can't get in due to operational risk or regulatory risk, and that's what makes retail make up such a large percentage of the market.
Another thing that's thrown around, it's used by criminals, it's used to launder money, perhaps more so than US dollars, for example, which we could cite as an example here too. What's your response to that?
My response to that is the US dollar has been the choice by criminals and money launderers for as long as it's been around. If you look at Bitcoin, since it is pseudonymous, right? My name isn't attached to an address, but it's a publicly transparent ledger. And as justice departments and criminals alike are finding, if you hack an exchange or if you are money laundering or whatever it might be, you can actually track that address. Every single transaction is recorded permanently forever.
It's traceable.
It's traceable, correct. So let's say a criminal does try to launder money or does steal money from an exchange. You or I or a chain analysis firm could look at that address, blacklist it, and then eventually when they do want to on or off their money on an on and off ramp like Coinbase or Gemini here in New York, it's not possible, right? Because you can actually trace it. With dollars, not so much. It's a lot harder to do with Bitcoin.
Yeah, look out for that suitcase. You said the magic word there, hack. And that's one of the things, actually, that I get thrown at me by more traditional analysts, I have to say, that aren't crypto specialists. And they say, look, crypto can be hacked here. And I think we have to distinguish between what's being hacked, whether it's the exchange or whether it's the currency itself.
Sure. Yeah, this gets brought up so much. The easiest analogy is a bank robbery to a bank. That doesn't make you question the legitimacy of the fiat currency system or banks in general. When a centralized third party has a security and vulnerability, let's say Binance gets hacked, right? It has nothing to do with the Bitcoin network or the Bitcoin software or Bitcoin itself being hacked. It's a business or a centralized third party being hacked. And the revolution with Bitcoin that people don't bring up when they talk about hacks is, since it is a digital bearer asset, you can actually control your coins. You control the keys, you control the coins. So you can mitigate that risk as an investor, as an institutional investor as well, as Coinbase and Zappo are coming into the game.
The other thing I get is rolled eyes. Explain what a cold wallet is, and this idea that the cryptocurrency itself is not actually held at the exchange. So even if the exchange is hacked, the crypto's held separately. Explain a cold wallet.
Yeah, exactly. So let's say you do have your exchange, your coins on an exchange like Coinbase or Gemini here in New York. You can withdraw those coins to a device that looks like a USB device, or you can keep a seed phrase in your head. So you can actually store these assets digitally, which wasn't possible before Bitcoin. You can mitigate against that risk of a hack or trusting any other centralized third party.
Why do we keep talking about Bitcoin, by the way? Because another criticism we get is, look, there's other currencies out there, Ethereum, Ripple. What's the relevance of Bitcoin as a proportion of the market, perhaps, in crypto?
Yeah, so Bitcoin right now makes up, I believe it's close to 70% of the total market cap of all crypto assets.
Wow.
Yeah, and the reason being is Bitcoin has established itself as a clear value prop, as kind of that digital scarcity or that digital gold, a store of value. And a lot of other currencies, it's still early. There are crypto assets that are interesting, Ethereum and NFTs and different things like that. It's just still very early. They're kind of fighting for that use case.
So what about further dilution? More and more cryptocurrencies get launched. Libra, an example, of course, from Facebook just in the last couple of months or so.
Yeah, that's the other side of this equation is since Bitcoin has established itself as the store of value, as digital scarcity, there will only be 21 million coins. All these other coins that cost nothing to produce increases the supply of other coins, and Libra doesn't do anything. It's really just kind of a basket of other fiat currencies. It shouldn't be even put really in the same category as Bitcoin.
We have to separate the two things, completely different things. One of the other things I think that people look at the price right now of Bitcoin and go, I've missed it, it's too expensive. People need to understand that if they want to invest, they can take a piece of a Bitcoin and not a full.
You can buy a fraction of a Bitcoin, yes. You can buy as one sat is actually the smallest denomination we'll go to. So you can buy one sat, which is 0.08 and then one sat of a Bitcoin, yeah.
Talk about transaction costs.
Transaction costs. So this gets overblown a lot as well. If you want to send a Bitcoin to me or to one of your friends or whoever it might be to be included in the next block, which would happen in about 10 minutes, it only costs 83 cents or $1. So transaction costs are actually much lower than a lot of maybe competing coins will make you believe. And also you have to consider that the average transaction size of a lot of Bitcoin transactions are much higher than a typical credit card transaction or a typical cash transaction.
So actually it's lowering the cost.
Correct.
Transaction costs
Correct.
here. What about regulation? If we see broader regulation, whether that's of exchanges or announcements of crypto to some degree, because the decentralized nature here is arguably one of the selling points too, does that help or hinder?
I don't think there's a bad thing with regulation as long as it's not stifling innovation. There are some negative side effects of this, of users or residents in New York or some parts of the United States aren't able to buy or trade certain cryptocurrencies. But as long as it's aimed at helping or protecting retail investors, I think that's a good thing. We're already seeing it with on and off ramps with Gemini here in New York or Coinbase as well.
Okay, final question here, and then we will get you back. Is Bitcoin ready to be a safe haven buy at this stage? Yeah,
so there's been a lot of talk about Bitcoin acting as a safe haven lately, and while correlations have increased, it is trading more in line with gold, and we are starting to see, as equities decrease, maybe Bitcoin and gold doing well on the back end of that. I'm not so sure you can draw that conclusion yet. If you look longer than just this year, the correlation on a relative scale is still pretty much uncorrelated to everything, and that's actually a good thing. It's still providing positive returns uncorrelated to other assets, which is kind of a dream asset for a lot of investors.
So there's an argument here to have it as a little piece of your broader portfolio, even if it's not a safe haven in your mind here.
Exactly. In some ways, it's actually reducing the risk of your total portfolio and earning you those returns.
Yeah, the lack of correlation with other